Right now, as I record this, Bitcoin is sitting at 67,000 with what might be the most compressed volume structure I've seen in 2 years. The S&P is down 8% in 6 weeks. Gold just flushed to 4,300. Every retail trader in the world is asking the same question. Is it time to buy the dip? And my answer, after running a complete multi-asset institutional framework across 50 instruments, the answer is no. Not because those assets aren't going to recover. They probably will, but because there is no signal yet. And trading without a signal is not an edge. It's gambling with extra steps. Today I'm going to show you the exact framework I used to know when to trade, and more importantly, when to sit on your hands. Because the traders who don't blow up in environments like this, they already know what I'm about to tell you. Welcome to Cantillon Research. I'm Jasper. This channel is about how institutional money actually moves and how we can read it before the retail crowd catches on. Let me start with something that sounds obvious, but most traders never actually internalize. Not being in the market is also a position. When you sit in cash doing a full risk off, you're not missing opportunities. You are preserving your ability to make the right opportunity when the setup actually forms. When you sit in cash doing a full risk off, you're not missing opportunities. You are preserving your ability to take the right opportunity when the setup actually forms. Think about what every major retail mistake has in common. Someone buys the dip at 70,000 on Bitcoin. Some averages down into a falling S&P. Someone sees gold from 10% from all-time highs and thinks this is cheap. All of those trades have the same flaw. They were made without a signal. They were made on price action alone, on emotion, on FOMO, and the feeling that surely it has to bounce now. And sometimes it does bounce, but without framework, you have no idea whether that bounce is the beginning of a reversal or a dead cat bounce. And without knowing that, you have no stop, no target, no size. You're just guessing. The job of a framework is to tell you when you have edge and when you do not. In a full risk-off environment, which is exactly where we are now, most instruments do not have an edge. The system is telling you that clearly. And the discipline to listen to it, that is a skill. So let me show you what I'm looking at in the institutional volume terminal right now. The top level signal is called Cantillon Flow. It has 3 layers: liquidity, equities, and risk. Think of them as a 3-rung ladder of capital flows through the system. Right now, all 3 layers, they are full risk off state. The composite score, which aggregates 9 sub-factors, is sitting at negative 8 out of 9. Yesterday, it was negative 10. That was the cycle worst. It has just started to stabilize, but stabilization is not a reversal. So here's what that means in practice. When the composite is below negative 5, the system enters a phase where most long setups, regardless of how good they look on the chart, are fighting the regime. You might get the move, but you are taking it against the current. Look at Bitcoin here. Beautiful compression setup. Volume is coiled to 93%. The SD2L is extreme active down here. That setup is building. And the system says, watch this, do not trade it yet. Why? Because there's no signal. The coiled reading is the system telling you that institutions are accumulating slowly, quietly at this level, but they haven't stepped in with conviction. When the signal fires, you see it. Until then, you're guessing alongside everyone else. Same story on the S&P. The SD2L fired all the way down. It is extreme active. That means we are at a historically significant mean reversion zone. We have an 82% win rate on the bear swing since the signal fired. But the stability reading is still 0 out of 2. The stability metric is the key. It measures whether institutional volume is stabilizing, whether these are buyers stepping in with size. Right now, no equity instrument in the watch list has printed a single stability point, not one. Until stability moves from 0 to 1 out of 2, there is no confirmation. The bounce has not been institutionally sponsored, and unsponsored bounces fail. Here we have the crude oil chart. Now here's where it gets interesting, because the system is not saying trade nothing forever. It is saying trade only what has a confirmed signal in the current regime. Yesterday was exactly one such setup on the oil. It was coiled 91%, the confluence score at 5, 3 factors aligned. Supply side macro bid in a full risk off environment where the dollar strength is the dominant theme. Crude has its own logic, geopolitical supply premium, OPEC dynamics, dollar denominated commodity mechanics. It does not need equities to cooperate. The trigger was a break above the puck at 96. The setup fired, and crude is now at 103. That is a 7% move in roughly 24 hours from a clean framework confirmed signal. Compare that to someone who averaged into S&P dip 3 weeks ago. They bought at 6,800, held through the flush to 6,390 and are now down 6% while wondering whether to add more or cut. No signal, no stop, no framework, just a feeling. And this is the difference between systematic edge and hope-based trading. The coiled setup told you exactly where to enter, where the stop was, and what the target was. The framework said this has edge. Everything else said you don't. The question is not, can I make money trading in a full risk off environment? The question is, do I have enough edge to justify the risk? In most environments, the answer right now is no. So what do you do while you wait? And what are you waiting for? This is where having a framework becomes genuinely valuable. Because instead of refreshing charts and second guess yourself, you know exactly what needs to happen. In my system, there are 4 specific triggers that would signal a regime shift. So let me walk you through each one. TLT is the 20-year Treasury ETF. It's one of the most important charts I watch. Not because I trade bonds, but because TLT's behavior tells me whether institutional capital is rotating into safety or beginning to come off the sideline. Right now, TLT just flipped from deteriorating to improving. That's the first constructive read in weeks. But 85 is still the floor. If that breaks, the forced liquidation narrative deepens. So 88.5 is where I want to see it close to confirm layer 1 of the Cantillon Flow is re-engaging. So trigger 2, S&P 500 and the Nasdaq prints a stability of 1 out of 2. This is the institutional accumulation confirmation. When I see the stability metric ticks from 0 to 1 on a major equity index, especially still at these SD2L extremes, that tells me institutional buyers are stepping in with size. That is the sponsorship signal. That is when the bounce has legs. Bitcoin is sitting at maximum compression with the highest volume compression reading on the watch list. When the coil signal fires, and it will, the quality of the signal is enhanced by the equity daily tire the instrument sits in. That means the model applies an additional 10 point plus basis points of confidence to the setup. The historical win rate in this pattern is 92% over 500 samples with a 19-bar average hold. That is an extraordinary setup, but it requires the signal to fire. Right now, it has not. Now, this is a systematic indicator. As the Cantillon composite rises from the cycle through, the regime begins to transition. From -8 to -5 signals, the system is genuinely healing. not just bouncing. So that's the macro green light. Notice what I'm not doing. I'm not watching price. I'm not watching RSI. I'm not watching moving average crossovers. I'm watching the institutional order flow mechanics, volume composition, stability of bids, the rate of change in the regime composite, the VWAP deviation from anchored price. These are the things that tell you whether the buyers at a given level are institutions taking a position or retail traders bottom fishing into a falling knife. I want to talk to you about something that the charts can't capture, the psychological difficulty of sitting on your hands. Because you already know intellectually that patience is a virtue. You've heard it 100 times, but here's what's actually hard to do. When the market is moving in either direction, your brain is registering activity as opportunity. Every down candle looks like a buying opportunity. Every red session looks like a screaming discount. The lizard brain says, buy low, sell high. This is low, therefore I should buy. But that's not how institutional money thinks. Institutions are not trying to buy the lowest tick. They're trying to confirm regime and enter with the highest probability risk reward that they can find. They will sit in cash for weeks, sometimes months, waiting for the accumulation signal to develop. They will watch a setup compress from 50% to 93% and not touch it until the trigger fires, because they know that entering early, even a few percent, dramatically changes the risk reward profile and the management of the trade. The retail trader says, I missed 5%, but I'll catch the next 20. The institutional trader says, I haven't missed anything. The signal hasn't fired. There is no FOMO in rule-based systems. There is either edge or there is not. Right now, there is not, except for one trade that already fired. So here's the uncomfortable truth. Most retail traders would have made more money in the last month by simply closing their platform and going for a walk. Not because the setups weren't there, but because the discipline to identify when there are no setup and act accordingly is rarer than any technical skill. The traders who survive environments like this are not the ones who called the bottom. They are the ones who didn't trade the fake ones. One more thing worth noting. Today is the last trading day of Q1. Quarter end is a noise event. Pension funds rebalance, institutions mark books. They are forced buying of underperformers and forced selling of outperformers as managers adjust weightings. Correlation breaks down. Moves that look like signals are often just mechanical flows. This is exactly the wrong time to make a new trade based on a counter trend signal. If BTC starts moving up today, even if the S&P pops, the move has higher than normal probability of being quarter end mechanics, not institutional conviction. Wait for the week to close. Let Q2 open with clean books. Then evaluate the signals with fresh data. The framework will tell you when to act. So here what I want you to take away from this. In a full risk-off environment with all three Cantillon layers risk-off, stability readings across every equity instrument in the watch list, the correct trade is not long. It's not short. The correct trade is patience. If you have a stock that you really want to invest in, go in with very little capital, because this is not the time to go all in. The setups are building. BTC is coiled. Gold is coiled. TLT just flipped to improving. These will become signals. The regime will turn. When it does, you want capital. You want a clear head. You want to not have giving back 6% averaging into a falling knife because you couldn't stand watching the market without being in it. The most profitable trade this week is the one you didn't make. If you want to follow these signals in real time with the full framework read across 50 instruments, that's what the Cantillon Research Substack is for. The link is in the description. Elite subscribers, they get the fully daily brief, including the exact Cantillon readings you saw in the video. So if you found this useful, subscribe